In today's JNJ stock analysis, we're going to focus on two corporate events. So the first is Kenvue. That's where JNJ is spinning out their consumer products division. The second corporate event is their acquisition of a heart pump company. So let's just start with this question. What if you lived for 50 more years and you could only invest in one stock? This is an interesting thing to think about. Most people will probably start to go into the more exciting stocks and say, well, I'd invest in Tesla. Oh, what if Elon Musk dies, right? That might put a damper in Tesla's growth. Others might say Google. Well, you have Microsoft putting a heavy investment into OpenAI, so that can potentially affect Google. And the point is, with these tech companies, they come and go more quickly than ever. So if you take a look at companies that were the largest in the world 50 years ago, none of those names would be listed today. So given our aversion to risk, we'd probably look to pick a dividend champion. That's a company that's not only paid a dividend, but increased it for 25 years or more. Because in the long run, it's not about thriving, it's about surviving. So the last thing that you want to have happen if you're invested in one stock is to have that company go bust. So if we could only own one stock, we'd probably start thinking about that more at a holistic level. So if you look at one theme that's quite popular among investors and always has been, especially the most wealthy, it's longevity. That's because the one thing that you can't buy is more time on this planet. So healthcare spending will always be there. That's not going away anytime soon. So we might ask the question, well, what's the best healthcare stock you could own? And if you could imagine what that looked like, ideally, it would be a conglomerate-like structure that would provide internal diversification. So actually holding one stock, if you had to do that, you'd want to hold a conglomerate because then you would get the diversification effect. So when we go to look for healthcare stocks that might be appealing from a dividend growth perspective, we would use our strategy that we've spent over a decade building and where the majority of our money is invested in, and that's Quantigens. And we've built this strategy around the safety of dividends and dividend growth. It acts like a bond, it pays like a stock, and 90% of your long-term performance comes from dividends. So we refresh this twice a year. That's mainly because it doesn't change very often, which is great. And we recently finished our refresh. We'll be releasing that report to our premium subscribers probably today. And I pulled out the top 4 stocks based on Q-score. And in this strategy, what we do is we take these factors that you see here, 7 of them, the year's increasing dividend, market cap, yield, payout ratio, etc. And we use that to calculate a Q-score, which represents the quality of the stock. So these rankings actually don't change very much over time because that's the way that we've built the strategy. When you look at the top 4 stocks in our strategy, at the very top is a conglomerate. That's 3M. Then you have Johnson & Johnson, also a conglomerate-ish sort of company. Then you have Illinois Tool Works and Mickey D's. Now, what's interesting about these names is because these companies are so successful that the litigious society of the United States of America is now going after them. And there's the talc baby powder problem with J&J, where J&J claims that there isn't a problem with their formulation, yet the class action lawsuits say otherwise, so they ended up pulling that product. You have a faulty earplug lawsuit potentially threatening to bankrupt one of America's greatest companies. We have to use common sense. Instead of appealing to people's heartstrings, we should have judges and juries that start to think to themselves, is awarding $30 million per the 20 or hundreds of thousands of people that are now claiming they had used these faulty earplugs and to bankrupt a company, does that make sense to do? If we want to have companies that produce lots of different products, especially in the healthcare sector, we have to afford them some sort of protection from these exorbitant lawsuits that are filed. Then you have Mickey D's, which is being shaken down by an extortionist who should be put in jail. So these are problems that unfortunately aren't reflected in this strategy, and these are things that we pay very close attention to, because all of these things, what they have in common are ambulance chasers, and that's a reflection on the litigious society of the United States. So that is certainly a problem. Now, when we start thinking about income growth over time, the average company in our strategy, let's say in the portfolio that we're holding of 30 stocks based on this strategy, grew dividends over the past decade by around 8% per year. On average, that's remarkable. Here's what it looks like when you have a income stream that grows at 8% over time. So you can see here on the left, year zero is $1,000, year one, $1,080, and it starts going down the list. And then this table on the right is where things get very interesting. So at year 40, you'd be receiving over $22,000 in income versus the $1,000 in income that you started with. You're handily beating inflation. Now, if you had a fixed income, like most retirees do, right? They have their Social Security that's fixed, hopefully, and they have some fixed income because that's what their financial advisor told them to do. In 30 years, that money will have lost half its purchasing power based on 3% inflation. So not only are you solving that problem, but you're actually improving your quality of life as time goes on. That's why we love dividend growth investing. So when we take a look, getting back to JNJ, which is a company, it's a dividend king. They've increased their dividend for over 50 years now, which is a remarkable feat. And when you have a track record like that, you expect a company to be able to continue down that path. So looking at what J&J does, you see here they've broken down their business into three segments. You have consumer health, which is what they're spinning off into a IPO called Kenvue. Then you have pharmaceuticals, which make up the majority of their business, and then medical technology sales there at the bottom. Now, what happens when you spin out this consumer health segment is that they then become overweight in pharma, and they're actually looking to resolve that with their latest acquisition, or at least address that to some extent. Other point I wanted to make here regarding gross margins, consumer health has very healthy gross margins of 56%, whilst J&J as a whole has remarkably high gross margins of 68%. So they're not losing profitability when they spin that unit out. Now, an article from Guru Focus, quite good, makes a couple good points. So they say that consumer health is a mature island in a company focused on the high risks and rewards of the pharmaceutical medtech industries, and that executives believe investors aren't seeing the full worth of the company because of that consumer division. This would be referred to as the conglomerate effect, which we've written about before, where conglomerates actually enjoy a discount to the market for various reasons. And that other companies such as Merck, they disposed of their consumer healthcare division, while Glaxo, Pfizer, and Sanofi are also following the same path. And the article goes on to say that, well, investors generally do not care about this kind of diversification anymore. Instead, they'd rather do their own diversification through stocks or mutual funds. Wrong. We do care about this because it increases the likelihood that J&J will be able to continue growing their dividend into infinity. So when we invest in dividend growth stocks, that's all we focus on. We always want to see that dividend be increasing, even if it's by the smallest of amount. As soon as they stop increasing the dividend, we dump them like a hot potato. So we disagree a bit there. But what J&J is now doing, that they've spun that division out, and we'll talk a little bit about what that means for investors here in a second, but they're going to acquire a company called Abiomed. And this is an interesting operation. The first thing that stands out here, you can see the revenue growth has been quite strong. We don't have the yearly chart up. We didn't include it in this deck, but you can see here on a quarterly basis, they're doing about $1 billion a year. But look at that gross margin in the lower left, over 80%. That's remarkable. Like most software businesses would be lucky to get gross margins that look like that. Why are they so healthy? Well, here's their product. Look at that kit on the left. How much do you think it costs some Chinese person to make that? Nothing. And then you see on the right, that kit is then used to pump blood within the heart. So these are heart heart pumps, what is known as the world's smallest heart pump, Impella. And they've had 510K clearance for a while, exclusive FDA approvals. And what you need to pay attention to is the last bullet point here, 850 million R&D and all the patents and patents pending. When you have a cash cow, a very cheap product that's been approved and generating tons of cash, other firms will look at that and quickly step in to get a piece of that pie, which is why you need to protect that, hold that very close to you. And that's what they're doing here with all this R&D. And you look at the outcomes. We're not rocket surgeons here at Nanalyze, so we simply just look at what others say about a product and its benefits, but you can read some of the bits here that it improves survival. There's cost savings. That raises everybody's eyebrows in terms of this product being evaluated. So it's a good fit for J&J apparently. And when you look at their med tech segment, this may be a little hard to read, but this is some very rich data that they include as a company. And you can see here how they're showing the increase over, this would be year over year for the third quarter for each segment within the medtech segment. You can see here operational growth offset by currency. So look at how big of an impact currency has. And this may be working against them now, but it's going to work at some point in the other direction and benefit investors. So this is the importance of having a multinational firm in your portfolio. But somewhere in this mix, then you will see reflected the Abiomed acquisition, and it's quite small. So they expect, I think, somewhere in the range of 5 cents on earnings per share coming from this acquisition. I mean, you can do the numbers. So these are quarterly. You have that medtech segment doing $6.7 billion. Well, what did we see? Biomed doing $275 million, just a tiny little fraction. But that just shows you what a giant J&J is and how they're thinking ahead in terms of the growth of that unit that they've acquired and how it will add value to their earnings per share number over time. Now, what do we do with shares that we'll get from that spinoff? Well, spinoffs are kind of like special dividends, and we exclude these. So a company like, let's see, Ben Templeton, they pay a special dividend, once every 4 years. It's sort of random, but not. And we exclude those when we look at the performance of our strategy. We also exclude these spinoffs. Previously, we've just treated them as cash bonuses. Oh, there's a spinoff, we'll sell the shares immediately. And if you're a retiree, then that's maybe you can go on an extra holiday that year. But when we look at the estimated value of this spinoff, which is what J&J investors will be asking, well, let's assume a 10K position, and then let's divide out revenues. So there's $3.8 billion coming from consumer health, divided by a total J&J revenues of 23.8, so 16%. So let's say it looks something like $1,600 on a 10K position. What'll happen is that when the spinoff happens, shares of J&J will fall accordingly, right? The old arbitrage effect there's coming into play. So J&J is actually our largest single stock holding. That's not intentional. It just happens to have performed very well. So what we're probably going to do is sell that spinoff immediately, obviously leaving our J&J as it was. And there won't be any tax implications for that because we've been holding J&J for a very long time. And we'll probably take that money and let our premium subscribers know what we're going to do with it, which is to probably add some income somewhere else within our 30 stock portfolio. So when we look at J&J, and this is quite important how you want to think about checking in with a stock. This is the first time we've checked in with J&J, I think, for, 4 or 5 years. It just sits there and generates a bigger paycheck every year. And when you look at how likely it is that mailbox money keeps coming in, you want to compare their historical earnings, or let's say earnings to dividends. That's called a payout ratio. So let's take Q3 here. These numbers are slightly off, but you get the general idea. So if you take Q3 on the left there, and you see they had earnings there, actual earnings of $2.55. Then you take Q3 in the table on the right, they paid a dividend of $1.13. that gives them a lot of leeway. They could actually have declining earnings for a very long time and still keep increasing that dividend. Lots of companies do. That's how they manage that track record. And as an investor, that's just great. You don't even notice it. You sleep very well at night knowing that you're getting an increase every year. So hopefully, as a result of the business that J&J is getting up to, they're going to have a better likelihood of doing that over time. So we still think J&J is probably the best dividend growth stock out there if you had to hold one, albeit one now that is less diversified. It's business as usual for J&J. They continue to perform. Hopefully they can manage through the many class action lawsuits they're dealing with. When that spinoff happens, we'll immediately sell our Kenvue shares and we'll let Nanalyze Premium subscribers know where that cash is going to go next. So I've put up a video here that you might be interested in on another dividend champion. And before you watch that, please go ahead and click the Nanalyze logo here on the right and subscribe to support our channel. Thanks for taking the time to watch this today.